Hi, Steve Van Metre here. Welcome to Macro Monday, where we answer your questions, try to make sense of markets that really don't make any sense, and above all, talk macro. So oil was negative today, and I don't care. It doesn't matter. What is actually quite amusing to me because people don't understand how the system works. And what's interesting is people that trade it don't understand how the system works. So let me try to explain to you what happened today. So as you probably heard, crude oil went negative. This is in the futures contracts, the May futures contracts, which expire tomorrow. So what happens is people speculate on oil. In fact, we know if you've watched any Monday video, we look at how hedge funds are positioned. We know they are long oil, meaning they're betting on oil prices going up. Wait, where's my up? There we go. Bulls. They're betting on oil prices going up. But what actually happened? Well, we all know that the oil prices went down. So here's what happens when you own a futures contract. On delivery day, tomorrow, you take delivery of your oil unless you either sell it or roll it over to the next futures contract, which would be June in this case. Now, I don't know if there's a cost to roll it over. I'm not licensed to trade futures. If you need one, I don't have one. And if you don't, I don't do them. I don't trade futures. So this is where my knowledge of exactly how the machine works is a little thin. But I'll presume there's a cost to roll over because in this world, there's a cost for everything. So what happened today is people found out, hey, your contract's coming due and you have to take delivery. And guess what? There's nothing available in storage. There's nothing available. So all of a sudden prices plummeted and went negative because it was all the market was saying is, if you're so stupid that you're not going to roll this over to the June contract, you get to pay us because there's nowhere to put this and we don't want it. And as you can probably guess, people are rolling their contract over to June. Now, is that great? Well, not as great as it might seem. For some reason, my chart stopped updating, and it could be from all the mess that was going on. But the price up here should be pretty accurate, saying that the June contract for crude oil, yeah, there it is, June 2020, light sweet crude is $21.20, or whatever it's going to change to while I'm talking. That in itself is a problem to begin with, because oil under 35 a barrel is bad for the domestic oil industry. There's just no way around it. It's just bad. So at 21 or negative, it doesn't matter. Now, if the June contracts head to negative, well, that's a symptom of a bigger problem, meaning demand isn't coming back and there's still too much supply. So what happened today, yes, has never happened before in history. Tomorrow, it will all be, well, something not water under the bridge, but oil down a pipeline, perhaps, maybe is a better analogy. But if the June contract continues to go down, it's a symptom of much, much bigger problems because these speculators, they can only roll this thing. I mean, there's only a point where you can roll it so long before you end up losing money, and they're going to lose a lot of money to begin with. And due to the speculative positioning in crude, I think prices are headed negative. And let's take a look at that. In fact, there was a question that came in, and normally questions come on a first come, first served basis. But because today we're talking about speculative positioning, this question gets to be moved front of the line because it does actually matter. The question is, how do we know how hedge funds are positioned? I didn't know they had to report. Well, the answer is they have to report their futures contracts. They don't have to report their individual stock holdings on a weekly basis or anything like that. But you have to report as a commercial hedger or as a speculative hedger, which is mostly hedge funds, how you are positioned. And where that happens at is a Commodity and Futures Trading Corporation or Commission under what's called the Commitment of Traders Report. So when we go to the Hedgeopia website, you'll see it's following futures position of non-commercials. So that's speculative positions in the futures market. So let's go and look at oil. We're going to come back and look at this in a little bit. Where's oil here? WTI. So what you can see is if you really want to go back, people were long oil in October. We'll assume they got out of some of these positions and they took new longs somewhere around $40 a barrel back in late 18, early 19. And then they took more longs in here at around 50 a barrel. And now it's at 21. And they have nowhere to put this, nowhere to go, and the economy is slowing down. So they're going to roll these at some point, but the pain comes is when they decide to exit these contracts and eat the loss. And to do that, they have to short oil. So you can imagine at 21 a barrel, if a bunch of speculators started shorting oil, where it's going. All right, let's get on to the normal order of questions. I'm not that question was abnormal. That was, I didn't mean to imply. That was a great question because it matters. So the way it works is you have to report your futures positions every Tuesday, and then they're released to the public every Friday. So you do get some anonymity. You get to hide your positions for a little while. All right, thank you for your interesting videos. Keep it up. Hey, glad you like it. I'm struggling to understand your thesis. Fair enough. About A, about inflation and interest rates. B, about bond yields in the stock market. All right. With all respect, are you sure you don't confuse the cause and effect? I'm pretty sure, but I could be wrong. But I'm pretty sure. You show how increasing interest rates always caused inflation to go up. All right, let's clarify that statement. If I said interest rates, I'm really talking about treasury yields. So increasing treasury yields, which is why you showed my chart, always cause inflation to go up. So let's go, and I think I pulled up a chart on that. Let's see. Nope. Okay. Yeah, that it was treasury yields. And then you can see that here's the chart of the federal funds rate in red, and it's reacting to treasury yields going higher. So yields start going up, and then the Fed panics about, inflation, because the bond market is the sayer of truth. When yields start going up, the Fed is soon to react. And you can see that they didn't react back here in 2013, but they did react in 2016, 2017. But the Fed is reacting to the bond market because the CPI lags. So why in fact, I answered my question before I said it. So why do we see this as CPI? It's because CPI lags yields, so Fed lags yields. That's how it works every time. So and this is a confusing area because sometimes people hear interest rates, they assume it's the federal funds rate. It's really treasury yields that really is the key here. The Fed is always reacting to that. So according to my mainstream belief, interest rates are only raised as a countermeasure following inflation going up too fast. That is correct. The Fed only raises the Fed. So this is a federal funds rate. But the market, the Fed does not control treasury yields. They don't control 5, 7, 10, or 30-year yields. Higher rates motivate deposits against spending before the economy overheats and also makes cash more attractive. That's the idea, to slow down the equity bubble. In the graph that the consumer price index went up before 10-year treasury rates went up, for example, late 60s and 70s. So you can't use the 60s and 70s because why did we have inflation so much? We went off the gold standard. So yields are rising to absorb all the currency that was printed. And we can't say that today. The system is different now. The system, we're off the dollar standard. That was a reaction to it. So we can't really compare that. So you want to look at everything after 1981. At least that's what I do in this case. I noted after we went up the gold standard, you can't apply this methodology today since we're on the dollar standard. Anything prior to 1981 when interest rate peaks is largely irrelevant. So there's a point where you can't go back too far. But I think and if I got your question wrong, again, look at treasury yields versus the federal funds rate. That's really the key, is treasury yields tell you where everything's going. Next, if stocks bottom before yields, they usually don't, then we should not expect yields to confirm the stock market rally just yet. They can catch up later this month without stocks retesting the market. No, I got a chart for that. So when in doubt, look at a chart. So here we have 10-year treasury yields in the Wilshire 5000, and we can see in the 1990 the stocks did bottom slightly before yields, but yields went on. They normally do go lower after a recession because the consumer's got to rebuild their balance sheet. But let's go and look at here in 2001, they bottomed together, and then they both rolled over and went down. So that makes sense. So they did bottom together. They both rolled over and went down, and then they went up together. So you notice that relationship. They go down together, they go up together. And then they went down together again. And here we see yields bottoming actually before stocks in 2009. But then yields would roll over and went down again, which is not unusual. When consumers have to repair their balance sheets and they don't borrow, yields eventually roll over and go down. Now, what didn't happen is stocks didn't fall all the way down. Now, why could have that been? Most likely due to corporate share buybacks. But we see this huge gap. Normally, they kind of follow each other pretty well, as I've always said that they do. But these big gaps in between them is not healthy. It tells you that they've got to come back together, because we can kind of move it around and see that when they get far apart, stocks do come back down. Happens every time. All right, so yeah, I think we'll see them bottom together. The question is what happens after that, or do they rise and then roll over? Do yields roll over and go down? The stocks go up? We don't know, but I don't think we're going to see a V recovery. The two do need to confirm each other, and yields are not confirming stock prices at all. Because I keep hearing the recession only comes after the bear market. No. Where am I? No, I'm clicking. There we go. Here you see the recession happens during the bear market. So what the official recession is one thing, but you can see the recession happens during the bear market. It's definitely not after. No. Let's see. Yeah, bear markets happen during recessions and mark the end of a recession. Yields will make a bottom during recessions, but generally make their final bottom after the recession as balance sheets get repaired. That it doesn't always happen that way, but that's usually the way it goes. So then the follow-up question on that is that would imply recession for a stock market bottom, yields bottom. And no, it would be recession, bear market, yields bottom. Stocks are always the last to figure out we're in recession. Always. Hi, Steven. Really like your videos and would like to ask you a question if you could answer one in your videos. You betcha. I'm glad you enjoy the videos. So what do you think are some indicators to help determine the direction crude oil is going? Currently, I just look at WTI crude futures and EIA reports about supply and demand. That's exactly what I do, except you guys are not going to like the answer to this. The answer is Treasury yields. I know you're like, really? Yes. The bond market tells you everything. So let's zoom this chart in a little bit. And you can see that 3-month Treasury yield kind of give us a nice direction of where crude oil is going. So we see, yields are going up, and then crude oil goes up, yields go down, crude goes down. This time here was something completely else, but yields were going down and that reverted crude oil. The Fed was suppressing yields here, but we do know 10-year yields and other yields were rising, but then eventually crude comes crumbling back down, and then it rallied up with the 3-month yields, and then as 3 months head down, look what happened. So crude is, man, if you can figure out the direction of crude, you can make a ton of money. It's really hard to figure out from a macro view, zooming way out. Treasury yields. Answer to many questions is Treasury yields. All right, thank you for providing us so invaluable information and views. Well, you're very welcome. They're really great. Cool. Glad you like them. I had a quick question. You mentioned in your video that this time the market will play as similar as to the 2008 crisis. Yes, that is my opinion, and perhaps the opinion of a few others, but it is my opinion, which I validated by lots of charts, but it doesn't mean it will happen that way. There are a couple of factors that I would like to point out. Number one, the Treasury interest rate in 2007-8 was, say, 30-year was around 5%. Yes, higher yields aren't really relevant in how a recession plays out. In fact, I would argue that lower the starting yield going into recession, the worse it's going to be. Although for the Fed, see, they want to start with higher yields so they can lower them. When you're sitting near the zero bound like we are, you run out of runway real fast. So I don't think that's really a factor. I think it's a negative factor that yields are lower. Number two, there was a financial system breakdown, which was a structural breakdown. Hence, it needed time to fix. And I think there'll be another one, only bigger than the last one. That's not an opinion held by many, but that's mine. So my question is that when inflation goes down, in fact, negative, so let's say it does go to negative 2%, he says in his question, or she, don't know for sure. I don't remember, and I don't use names. So how about that? So the real yield of bonds becomes 3.5% now compared to 7%. Correct. As the markets from a 2-3 year perspective were looking bad, 7% was attractive return for investors to switch to bonds. You're assuming investors did switch to bonds. They didn't probably until 2009. They're always late. Investors are always late. Is there a possibility that 2.5 to 3.5% real yields on bonds today might not be attractive for investors to switch? No, it always is attractive. Professional money managers, speculators, anybody in the market wants to make money. Retail investors will always be the last to figure this out, so you can kind of exclude them. But yes, the market will see the switch, and there will be people that will play chase in it. As the SPY itself gives a 2.25% yield, well, that can go down. Yeah, as they said, could go down with dividend cuts. But still, yeah, people think that buying stocks is for a dividend is smart. And it's great until stock market goes down, and then the dividend goes down with it. And then you've been 100% better off buying a bond or an annuity because you didn't lose your money in the process of doing it. So no, I don't think the dividend yield is a factor there. Especially everyone is expecting a drastic recovery once COVID-19 improves. Yeah, well, they're wrong about that. So no, I do think compared to crashing stock prices and deflation, so you got to understand, deflation will bring stock prices down. So any form of positive carry in the bond market will bring people to the door. They will happen. And again, COVID-19 wasn't the cause of the recession. We were headed into one to begin with. It's just making it a lot worse. So not sure if you covered this lately. Questions from your podcast. Okay. Even though there's supposed to be a stimulus or forgiveness for the mortgage loans, I don't think there's a forgiveness on mortgage loans. I think what I'm hearing, and I could be wrong, is some mortgage companies are giving people 90 days grace, but they have to make up those payments. I don't think they're forgiving them. Do you see a mortgage crisis like 2008? Yes. Why? Because housing prices go down during recessions. People are going to be underwater and people will default. And are there people speculating in real estate going into this? Yes. I mean, there are people that do those sharing programs. Whether you rent your house out, I don't know, remember what the name of the companies are, but there are people out there that bought lots of homes and made their full-time job renting out homes through these websites. Yeah, they're going to be upside down. So with real estate tanking and banks going under, yeah, I think banks are going to go under, and not the big banks, but the little banks, because the big banks, because of the Fed bailout, got to cherry pick all the loans they wanted, and they stuck the garbage loans like auto loans and home equity lines down to the mid and small banks. Well, guess what happens when home prices go down? Who's going to carry the bag? Who's third in line, usually, or second line, depending on how many mortgages? It's the equity lines, always the last player. What about car loans? We already saw 90-day delinquencies on auto loans. Subprime auto loans were higher than they were during the great financial crisis. So yeah, I suspect there's going to be a lot of problems there. Same question for auto loans. Yep, just answer to auto manufacturers. Yeah, they're going to be in trouble. Neither can be good for the stock market. Nope, it won't. Okay, so that's questions for today, and we'll carry on. There's a question that I see bond prices taking off today as you predicted. You mentioned there'd be 2 peaks. How do we know when the first peak has been reached? That I'm going to kind of answer a little bit today and maybe a little bit on Wednesday. So let's go and look at how hedge funds are positioned. All right, so 10-year, and thank you, Hedgeopia, 10-year Treasury bond short position increased slightly. Remember, here's one way you know yields are at bond prices are at peak or yields are at bottom. Speculators are long. They're short. How about 30-year? They're even more short. Now, not only are we at the second largest short position for confirmed, we're almost at the largest short position in history. So hedge funds are very, very short the bond market. Again, you want to know when to get out. When they start going long is usually when the time to go is. We already looked at crude, S&P 500. Speculators are short. Why? Because they think this rally is going to fade and roll over. Not often I say this, but I think they're right. How about gold? We're seeing gold positions, long gold contracts. Speculators are backing off gold. Usually that's a sign that gold prices are going to come down. At least we've seen that in the past. That would be consistent with my view that gold is way overvalued and will contract as real yields go positive. NASDAQ, they're still, well, they backed off their NASDAQ longs a little bit. And Russell 2000 small caps, they increased their short position, and hopefully they're trying to capitalize on small caps rolling over and headed lower. Again, I don't often agree, but this is one time I do agree. Dollar, they're neutral on the dollar. I still think the dollar blasts off and goes higher. And they're slightly more short on the VIX, which doesn't make sense. If you're betting stock prices go down, you want to be long the VIX unless you're hedging that. But they've been short the VIX for a long time, so it doesn't make a tremendous amount of sense to me. But probably the chart that kind of really caught my attention when I was pulling up the Hedgeopia page was the top-heavy QQQ, or the NASDAQ 100. Top 5 holdings account for 45.2% of the whole index. So Apple, Microsoft, Amazon, Google, Facebook. 45.2% of the index. And people say this market's going to go higher. Usually when this happens, things go wrong. Wait till all these people start selling this stock and have to get out, and they're going to find there's no buyers. It's going to be very, very, very interesting to me. All right, let's go and take a look at some charts. S&P 500 rejected its 50-day moving average. This green line here rejected at resistance. Reports are saying the quant computers that have mostly driven this market, along with retail investors playing chase, are going to run out of money around the next day or two. And if that they do, they might start playing chase on the downside, and there could be a very strong reversal. Taking a look at 30-year Treasury yields, we can see that this was really a move now that the sellers needed to drive yields higher. So it came down here, hit support, ball in the seller's court. Sellers need to short and bring yields up. And what did we find after Friday's big move? Sellers really ran out of demand. We can go look at TLT, and we can see that it made a pretty big move today. I was really watching this most of the day, and when it took off, I was like, wow, that's pretty cool. I wasn't expecting that. I really was starting to expect that the sellers were going to try to drive it down here, but sellers obviously weren't playing very strong hand today. And again, the ball is in the seller's court because the Fed is buying, pushing bond prices up. And as we can see based on the futures position, they just don't have a lot of ammunition in their arsenal. A question that's coming up, and I kind of want to mention, what happens with, why does the dollar matter? Why do I keep saying when it breaks out of 103, there's problems that are going to happen? Well, think of this. If you needed dollars and you were selling crude, because you're a foreign producer of crude and you need dollars, and you need $100, you're effectively going to sell 5 barrels of oil to get the $100. So as crude prices go down, it just means they have to sell more and more and more to get dollars. And if the dollar goes up, it just causes the market to become illiquid. You got to remember, the whole purpose of the Fed's easing right now is to ease the dollar, to get the dollar to go down and to create more dollars to ease the shortage. So a stronger dollar causes the stock market to just blow apart. It causes investments to, or loans to break as people can't pay on them. It causes havoc in the U.S. financial system, causes interest rates to go down, which causes financial conditions to tighten. It's not good. This is exactly how the great financial crisis played out. The dollar blew straight higher, and the Fed could not stop it. I mean, they went to outrageous measures to do it, and they were finally successful, but not after a massive amount of damage had already happened. They're trying to avert that, but it's not working. The dollars are not getting in the hands of people that need it. And low oil is not helping that either. And if you're a buyer of oil, I mean, that's good, but right now, who wants to buy oil? The global economy is effectively shut down. So that's kind of why the dollar is a problem, and a rising dollar is a problem. And I look at this and I think, man, this thing's going to blow through 103, and maximum pain is going to occur. Let's take a quick look at emerging markets. That's what I want to look at. I knew there was something I wanted to look at today. So emerging markets got up here. When emerging markets rise, it tells you where liquidity is coming into the market. But it got up to this dotted purple line that I marked as overhead resistance, and it kind of broke through and then came back down. Broke through and came back down. This needs to go higher to validate U.S. equities going up. If it doesn't, it's going to come down here and retest this support here at around 30 to 32. If it doesn't hold, then you have that great financial crisis problem. And you can see that happening in big sells. Here you see it in 2015. It came back up, hit this area of resistance, couldn't hold it. And then all of a sudden, boom, there was a big drop in the stock market. So the emerging markets kind of predicted that. And then if you look back to the great financial crisis, it couldn't bust through here really. It did briefly. And then all of a sudden pummeling lower and just tore the system apart because there was a dollar shortage. This is what's going to happen again, in my opinion. And people are not prepared for this. And the chart is telling us it's going to happen. And unfortunately, it's going to be pretty ugly. So sorry if I seemed a little out of form today. And it had nothing to do with oil prices being where they're at. Just maybe a lot on my mind of what's going on, the opportunities that are being created in this market for those who are looking at it from a macro lens and being patient, and a lot of pain coming from those who are speculating or just overloaded in stocks, especially when you look at 22% of the S&P in 5 companies, 45% of the NASDAQ, 5 companies. It doesn't end well when this happens. Anyways, I'm Steve Van Metre. Thanks for watching. Thanks for submitting your questions. We'll get on to more of those on Wednesday, and hopefully I can get caught up maybe close to Friday, if not early next week. But I appreciate all the great questions. Appreciate you watching, and I'll see you on Wednesday. Bye now. The content of this video is provides educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by a security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.